For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Well, it is, what is it? Is it, I almost said buckets.
Wow.
Here I go again. 2 seconds into the podcast, Professor
We
Plum.
need one of those things to slap and say, take two?
I guess. You would think. You would think that after all this time, I know it's managing your financial future. And here I go again. I realized on the last by the way, I'm Johnny Dean. I'm your podcast host. You, Professor Plum, are?
I'm Rick Plum.
That's right. You are a certified financial planner professional, CFP.
Yes,
and we got a lot of good stuff to talk about here. You are also an advisor.
Nope. Try it again.
I wrote it down. See what happens when you're not ready? Okay, give it to me.
Accredited
Wealth management advisor.
Yes.
Right?
AWMA.
That part I remember. It's AWMA. Like
yeah.
AWMA. You're the AWMA. You got a lot of designations. You're working on another one just because. And
I get challenged.
We're happy to. Well, you need a challenge in life or two. Speaking of challenges, now, our last episode, we got into some really heavy stuff there, and it was good.
Yeah.
And I want to back it up a little bit here and sort of back the camera up a little bit to talk about risk. Now, risk, can you define risk?
That you have an adverse outcome.
Okay. You expect a certain outcome.
Or no. Well, is expecting an adverse outcome a risk? Because you can still avoid it at that point. Risk is...
Well, you expect an outcome that you don't
receiving
get.
an unexpected outcome.
Well, yeah. You get an outcome. Now, there can be positive outcomes. When it comes to money,
Well, but that's
though,
positive risk.
when it comes to money, I got to thinking about this, and I kind of did a search of what are people's fears when it comes to money,
Okay.
retired or not.
I was going to say spiders, but you made it say money. So
I don't like spiders and snakes, but that ain't what it takes
don't
to
go
love
there.
me. Anyway, old song. Okay, so I'm looking up these fears, and I came up with, there's so many of them. Mainly, it's not having enough savings for retirement, fear of losing a job or your income, obviously.
Which means you don't have enough money in savings to get through that.
Correct. Fear of debt and financial obligations.
Which means you don't have enough money to pay it.
Right. I saw fear of spending, which means, I don't
fear
want
of
to give
spending
up.
because I don't want to worry about running out of money
Yeah, right. Fear of financial emergencies.
because I don't have the money to pay for it.
And fear of financial dependence. Now, what is all this? What's the theme of all this?
That I don't have enough money.
I have a fear of needing the money and not
having access to it,
not
or
having
it at all.
Not having it at all. I suppose you could borrow it, but that doesn't help. Kicks the can down the road a little bit. So the common theme in all of this is the risk that you need the money now, but you don't have access to it.
Okay.
That, to me, is it. Now, as I'm going through these things, there are a bunch of different angles that I could take here. One fear that I saw, fear of market volatility. Now, this is going to play into what I want to talk with you about today, Professor Plum.
Then if you are afraid of market volatility, then you are never going to be an investor. If you're afraid
Yes.
of the volatility is what makes investing.
Yes.
It gives the ability for something to earn more money than what a non-volatile bank account is going to earn.
Yes.
And so volatility, you're basically saying, I am afraid of the movement away from an expected outcome. And basically you're saying, I'm worried about it in a negative fashion because you want it to be in a positive fashion. You want it to be an unexpected positive return, but you're afraid of that unexpected negative return.
Yeah.
And if you're
exactly.
afraid of that unexpected negative return, you have to understand, how are you going to react to it if it actually happens?
Well, it looks to me like if you're afraid of market volatility, you're afraid that you got the money in the market and you're going to need the money at a certain point, but you won't have access to it because your stocks or stocks in
Whatever
general
that is
are down. They're down.
That's the only part of it. There is that, and that's a legitimate fear. That is a legitimate, but that can be handled. That can be taking. You can understand. You can find ways around that.
Find ways around
being afraid of that volatility.
Oh yeah.
But there's also the irrational fear that even if I don't need the money, I am afraid. And I've met people like this. It makes me anxious. It makes my stomach churn. I can't handle losses on my statement.
Yeah.
I do not want to see red ink on that statement. The person doesn't need the money. They may never need the money, and they are still afraid of the volatility, and it makes them uncomfortable to see a negative number ever. That's a different type of fear than I need $30,000 next year to pay the kids' tuition, and I'm afraid I'm not going to have it because the market's going to go through a tailspin between now and then. Okay, fine. That can be strategically moved away from. I'm afraid of the downturn. I don't need the money for 30. I don't ever need it, but I'm not willing to take and invest it because I'm afraid it might go down in value.
Well, then you've
okay.
Well, then
as long as you don't need
that.
the money,
you've solved that fear.
You can solve that, I guess, because you just put it in a CD
or whatever,
or
something that's got a guarantee. So I want to talk about these fears, but I want to talk about the risk of, I guess I would call it the risk of permanent loss.
Okay. I have $100,000. I put it in the stock market in 2021, the end of 2021, and in 2022, I've only got $80,000, and I sell because I'm afraid of losing more.
Yeah.
And now I have a permanent loss. Before, it wasn't permanent because I had the opportunity to have it recover.
It was only on paper.
Well, yeah, it was at that time. Before I sold, it was a paper loss. Now that paper loss could have gone down more, and it could have become a bigger paper loss. But by selling it, I turned it into a real loss. And with the paper loss, if I'm still invested in the market, let's just talk about the S&P or something like that, it has a chance to recover. And if you hadn't turned it into a permanent loss, it turned into a recovery. And if you're holding on to it now still, because you didn't need to spend it, that's a key issue right there. I did not need to spend the money. If I was able to hold on to it emotionally, I didn't have a loss. My paper loss turned into a paper gain. Now the question is, when do I sell it to lock in and realize that real gain?
Well, and this all comes back once again, Professor Plum, to needing the money and not having it.
Right.
Okay? This goes right back to that initial thing that I talked about at the top of this podcast. If you had money invested in the market at the end of 2021 that you needed to spend in 2022, it should not have been in the market.
It should not have been in the market because there is a chance of turning it into a non-negotiable, basically, because you had to have the money.
Yeah.
Non-negotiable permanent loss.
So if I've got money in the market, Professor Plum, but I've decided I don't need that money for 12, 13, 15 years, sometime way out there.
Right. I cannot guarantee that it will create a positive result, but at least you have a good chance. And we've never had a 15-year period of time where you didn't create a positive result.
Yeah. So would I care about the day-to-day fluctuations of the market if I need this money in 2038, 2039, and it's 2024, it's 15 years from now? Do I really care if the market drops precipitously over the next year?
With the money that you're investing today, you're always going to care. It's always going to leave a little bit in your stomach saying, ugh.
Well, I don't like it.
If you see it go down. But is that the best place for the money? Now, there are people that's not the right place for the money because they're the category I talked about before. They get too anxious, or they are too anxious.
All right, but then they shouldn't be in the market either.
They shouldn't be in the market regardless of their time horizon.
Let's talk about people who are investing.
As long as we can control our fear emotion and not sell and turn it into a permanent loss, it's like, when is the best time to invest? Is now a good time? Are we near the top of the market? Are we near a bottom of the market? Are we, if you're always looking only to get in at the bottom because I've heard this many times. People are like, oh, I can't invest now. The market's too high. I'm going to wait till the bottom, until it bottoms out. But it doesn't bottom out for 4 or 5 years. And by the time it does bottom out, it was higher then than when they looked at it before. And that's
the whole timing
market.
thing. You cannot time the market.
So if we're going to be an investor for 15 years, or more, now is a great time to invest.
Or down.
And you're probably Murphy's Law incarnate. And no matter when you invest, the next week the market's going to go down, because that's just what happens in your investing life. But you got 15 years to let it recover. And so the big thing is, if it does cut down and crash, how do I find some more money to invest? Not sell,
right?
But
so
where do I find more to invest?
Here's a stat that gets people all the time. If I have a 50% loss in something, okay, I own an asset and it goes down in value by 50%. I need to have it in order to get just back to even. I need 100% gain.
Correct. That's
right?
just math. Yes.
That's the basic math of it. And
25% loss, 33% gain.
Right. For some people, the just that alone would frighten them.
Right. And that's marketing has done a good job. They look at returns like that and they say, well, you did minus 25 one year, plus 33 the next year. Look, you're up by 8%. No, you're not. They add them together and average it out or whatever.
Right.
And my average return over that period of time was 4%. No, my average return was 0 because I just broke even. So you have to understand the math that's going into the situation, but that's just the way it works. Downward, obviously, 100% increase and 100% decrease are completely different.
Well, it is. So we've identified that people are that there are fears. If I could put it back again and say that the main fear is that I need money and I have no access to it. Every other fear, I think, points back to that particular mindset, okay?
And that whole concept that you're just talking about is why buckets of money, bucket strategy investing came to be.
Yes.
I mean, the whole idea is, if I need to spend money in the not too distant future where I cannot accept the volatility of the market, where I cannot be an investor, that money needs to be fairly safe or very safe. And so I want to be able to draw down enough money. I remember doing a seminar once, and we were talking about buckets and having enough money. The gentleman said, well, I've got enough money for 2 years. I've got, sitting in cash. Is that buckets? I go, this is the start of one.
Mm-hmm.
But what happens if the market takes, 2 years to get from top to bottom? You just bought your way to the bottom. Markets tend to go down, except for in 2020, tend to go down longer than a couple of months at a time. And it takes a while for them to recover. You're talking about from 2007, it went down. It didn't hit the bottom until March of 2009. And then it didn't recover back to the pre-2007 numbers for a couple of years. If you could have picked and choose, picking and investing on March 9th, that was great. But we had to be able to withstand that window of negativity. 2000 to 2010, the S&P went everywhere, but it started at point A and finished right at point A again, 10 years later. But it went down, started to recover, went down again, started to recover, went down again, and then took several years, got back up to 2007, crashed, and then got back up. By 2010, we were doing okay again from 2000 levels.
All right, so we know that, having some money in the markets can generally be, over a long period of time, a fairly good thing. Historically speaking,
we've been rewarded for staying in a nice, diversified,
right,
broad-based portfolio for 10, 15, 20 years.
So here's the conundrum that many people have, especially retirees who don't necessarily have as much control over how much income they have. They do, but the conundrum is that they say, okay, I get it. If I keep this money in the stock market, forget the volatility, and I let it ride or do whatever, I just leave it in there alone for the next 15 years, the odds are that I'm better off down the line. Not guaranteed.
We have a very high confidence.
Yes, we're a very high. So that part's taken care of. But here's my problem, Professor Plum. I got to have some money now.
Right.
I can't put all my money into that. And this is where you mentioned buckets a moment ago. It seems to always come back to that.
Well, this is also why you don't do the balanced strategy of 60-40, because both sides of that strategy can go down. And so it doesn't help everything. It helps reduce the severity of the downside, but it doesn't take the downside out of it. And when I need to spend something next year, the year after that, I don't want something that has gone down even a little bit in value.
We'll talk about let's talk for a moment about the traditional way. You mentioned the 60-40. A lot of people say, okay, well, you're 60 years old, so we're going to put you in, let's say.
Nice balanced portfolio.
Yeah, we're going to put you in 60% stocks, 40% bonds. How's that? Easy to do.
50-50.
50-50. 50% stocks, 50% bonds. And what's the reasoning behind that? That the traditional reasoning behind that?
The traditional reasoning is that the bonds and the stocks work in opposite directions of each other. And when one is going down, the other is going up. You've got cash flow on one side. It all works out, and it moderates the volatility.
So in other words,
it doesn't eliminate the volatility.
When stocks are doing well, supposedly I can draw down out of my stock portfolio for the money I need?
Right. But then they rebalance it back to 60-40
and then we
anyway.
rebalance 50-50, 60-40.
But it's just a nice feeling because we want to be balanced. Everybody wants to be in balance. And it makes sense, just from a very superficial level that, we want to have a balanced portfolio. But balanced portfolios can go down. And if the idea is that we want to never put ourselves in a position that we have to sell something when it's down to gain the cash flow that we need, then the balanced portfolio is not appropriate for the short term. Now, when I talk about short term, what is short term? 1 year? Yeah, that's short term. 2 years? Well, they've been down longer than 2 years. And so we have to then identify what is an appropriate time horizon for things to be able to recover. The other side of balanced portfolios it moderates the volatility on the upside too. So it's not perfect for the entire portfolio.
So you don't like the traditional 60-40,
not an all-inclusive, everything one and done. No, I don't like a balanced portfolio
because
for
of
a retirement income strategy by itself as a end-all, be-all, clear everything through that.
Because it creates additional risk.
Oh, yes.
Is that correct? Correct.
It creates that risk you were talking about, that I need some money and it's negative to where I was a year ago.
I don't have access to it. I gotta sell something.
If I have to sell something, it's down from where it was. I do not want to be in a position where I'm selling something that's down from where it was just to raise the cash flow that I need, that I knew I was going to need today.
Why would anybody put a client, let's say, in that position?
It's easy.
But it's irresponsible. I think.
To some degree. But
it is from a risk standpoint, and this episode is about risk. I believe that it's risky.
When interest rates were near zero, where safe accounts were earning 1% or less, the argument was it's irresponsible to have money in 0% interest rate environment. That's
because you can't earn. You
can't
earn
anything. And look at everything you're giving up. You're missing out on the returns that this balanced portfolio, whatever they want to call it, will give you. And you know what? For a little while, they were right. Because
about the irresponsible part. No, I will never agree with that. They were right that you might be giving up some on the upside.
Because the markets were up. Yeah. But there's also that downside, and we don't know when that downside is going to happen. And if we're selling assets out of a balanced portfolio to create the cash flow, because they don't create enough yield, they don't create enough internal cash flow by themselves to cover the distribution that we're usually trying to take, just on the pure cash flow standpoint.
Right.
You're going to end up selling something when it's down at some point. So this comes back into what's going to happen in the next 5 to 10 years with that fund, with that portfolio. Will you have nothing but positive years? Yeah, if that's the case, then you would have left something on the table by using a more conservative, like a bucket type strategy. But on the other side, if you have negative years in those first 10, it doesn't have to be all 10. It could be 2 or 3. It depends on how bad they are. You will be in a worse position. Can you then tell me what the next 10 years are going to be like in the market? Can you tell me that with certainty we're not going to have a downturn where you're going to end up selling something when the market's down? Because yes, you are leaving something on the table when the markets do nothing but go straight up.
But that never happens.
And
That has never happened, where the markets go only up. If the markets only went up, there'd be no risk. And if there's no risk, everybody would invest in it. And when everybody invests in something, it's going to topple over. So it's impossible.
But there are prolonged periods of positives.
Prolonged periods.
And, and we've seen the studies. The person that retired in 69 versus the person that retired in 79. The person who retired in 89 versus the person who retired in 99.
Then let me bring this up. You are correct. So if I had this 50-50, 60-40 balanced portfolio, right? And I retired December 31st, 2021,
right,
at the top of the market. And I start chopping off out of my,
you start taking your 4% out.
I start taking my 4% out of my balanced portfolio. And after 9, 10, 11 months, I'm looking at it, and it is way down. Not just because both the stocks and the bonds were down because the market was down, but because I'm also taking money out of it to spend it.
Yeah, your portfolio is down maybe 25% at this point.
I'm exacerbating the loss.
Yes, because when the market was at an all-time high, you needed to sell X number of shares to be able to get that 40 or 4%. You have $1 million portfolio or proverbial, and you want your $40,000, and so you're taking it out at $3,300 a month, 33 and 33 cents. That's $40,000 a year. And so the first month, if everything was $10 a share, you're selling 333 shares basically to get what you wanted. Well, then the markets go down and down and down. And by the 7th, 8th, 9th, 10th month, to get that same $3,300,
I'm selling way more shares.
You're selling 450 shares instead of 330. You're selling a lot more shares to get the same cash flow. And guess what? Now when it does recover, those shares aren't there.
There's that permanent loss I talked about a few minutes ago. There's the risk of permanent loss, and this is why you should...
you should not use a balanced portfolio for a withdrawal strategy.
No.
Not for the... you can use a balanced portfolio within a bucket strategy as a particular investment that is not required to be cash flow oriented for a series of years.
So in a word or two or three, Professor Plum, how does, for people that aren't familiar with this, how does the bucket strategy help alleviate this and contain somebody's fears where volatility of the markets don't matter?
Well, volatility is always going to affect us one way or another, but it doesn't affect your spending in the fact that we want to have 6-7 years of laddered treasuries, something safe and secure that that mature at the right time. So there's no liquidity issue. It's available. It's ready to go, and I can take it and withdraw it and spend it. And I haven't taken any risk with it. The market crashed. I'm Murphy's Law all the way, baby. And I put my money to work, and the next week, the markets crash and they go down 20%, 30%, or like they did in 2008, 40% plus. And I'm looking at a portion of my portfolio like, oh my gosh, that went down. Well, I'm still going to take my proverbial 44%. And I know that $1 today was $1 6-8 months ago. And I am not selling more shares than necessary to get that same dollar. I am not selling something at a loss. I am not participating in the downward movements of the market. I choose not to participate in that.
I'm a spectator
of the downward market.
Fairly grisly scene in the market.
And I have enough money on the sidelines to wait it out.
So go back to my when I said I'm encapsulating all these fears that I read about. What does it all come down to? It all comes down to my overall fear. All of these fears are based on, to repeat myself, all of these fears are based on the fact that what if I need the money and I don't have access to it? Okay,
well,
so
make sure you do.
So what the bucket strategy does is it aims to make sure that fear does not exist. In other words, no matter what the markets are doing, volatility up and down and up and down, but I still have access to the
cash
money
flow that I need without selling something at a loss.
That I need. And it's not going to hurt me, the volatility. I'm going to just watch it from the sidelines, cringe a little bit, or maybe not even watch it. Don't even open the statements if that bothers you.
I've heard the market's not doing well, but as long as I don't look at my statement, la, 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 I don't know about it.
And that's the point of this episode. The point of this episode is to say that let's take your fears, let's put your fears into one sentence, and that is the sentence I said a moment ago. How do I get rid of all of those fears, well, if I can negate that sentence and say that sentence doesn't matter, then I believe I'm taken care of, and my fears, they may not be totally gone. I mean, I may still have some. I just hate watching things go down. But at least when I'm retired, let's say, I don't have to worry about that cash flow. The money will be there when I need it.
You know where your cash flow is coming from, and you know that shorter term, and when I mean short term, 5, 6, 7, 8 year, negativity in the market is not going to affect your spending. You have the cash flow without worrying about what the market's doing.
So if I have,
on the other hand, you know that you've got money in the market, so that on those days that it goes up, and over time the markets have always gone up, you're participating in that as well.
So if I have the cash flow that I need, I go back over these fears. Not having enough savings for retirement.
Well, we've identified you do have enough savings.
You do have enough.
Yeah, because you by design created that bucket of savings for the anticipated period of time you're going to deal with this.
Now, if you're still working, fear of losing a job or income. Well,
that's
I would
why
say
you need emergency funds and things.
Fear of losing your income. So as a retired person, the job doesn't matter, but the income, fear of losing your income. Even if you are working, if you had some source of income, it's not going to bother you. Now, if you are working, fear of losing a job, I understand that. But we're talking about
so that's why you have to look at your emergency fund, your disability insurance in case you get hurt and you can't work, those things you get. There are other coverages they have to deal with.
So fear of losing your income is gone, if I may boldly say that. In this case, fear of debt and financial obligations. Well, let's assume you're not going overboard and creating huge amounts of debt. That you shouldn't do.
Well, that's all part of spending.
Debt, maybe you've got a mortgage, maybe you got a car payment, maybe you've got, there are certain debts that people have. But if you're able to
as long as you can make the payments and you're not
being buried by
high interest rates.
So fear of market volatility, well, that should be gone.
In fact, you should be embracing the market volatility for everything that you have in the market because you're hoping there is volatility for that.
Correct. All of these things. All of these fears can be
strategically put to rest.
Yes, I shouldn't say all. I don't mean to make
this
an
the emotional side of it.
Yeah, I don't mean to say that you won't have any financial fears. I think that's just ingrained in people.
And there is the fear that we won't have enough money in retirement for what we want, and that's true for some people. Because they didn't save early enough, they didn't save often enough.
Yeah, and that's on the accumulation side of it, and we haven't really talked about that.
And that's a mismatch between goals and actual reality.
Right. Now, I may have just enough in retirement to cover my basic needs and no more, but that's not really the strategy problem. That's more of, you just didn't save.
I just want to
spend
and spend and spend and spend.
Correct. So let's keep that.
We've got to stay in reality. And, if you're saying, well, I've been making, $250,000 a year and I want to be able to retire with the same basic income, but I've been spending $250,000 a year every year too.
Hey, it happens. It happens.
And I haven't built up any nest egg. And so all I'm going to have at retirement is Social Security. We have a spending and portfolio disconnect.
There's no shortage of articles and books out there and seminars and people with advice on how to accumulate wealth, how to find the right stock, how to,
The hardest part about accumulating wealth is prying it out of your pocket to get it invested for the future.
Right. So that's one set of skills. You just don't see a whole lot of the other side, which is how to potentially maintain that wealth as you're taking money out of your
accumulating
portfolio.
Wealth, you're looking to take advantage of the volatility of the market through dollar cost averaging and things of that nature. Creating a portfolio that will distribute income to you, cash flow to you over your remaining years, your retirement years, you're trying to do the exact opposite. You're trying to protect against the volatility of the market while still utilizing that volatility to your advantage. It's a different game plan. You can't just use the same, as you get closer to retirement, you become more conservative. That is an overall true statement. But you still want to use the volatility to your advantage. You want to invest in the volatility. But when you get to retirement, just continuing doing the same thing you were doing before isn't going to work because now volatility is going to work against you.
Right. So the person who's really good at accumulating may be horrible at the other side, which is at the distribution phase. And that's why we're here to help you out. We talk about managing your financial future. That's a good title for a podcast, by the way.
Managing 171 of them.
This is 173 of them.
Oh, excuse me.
That's right. When we talk about managing, this is what we mean. And this is why we kind of focus on this particular, we've been focusing this season, I think.
On buckets?
On buckets and the reason we do it and why it's important to think about this stuff. It's one thing to accumulate. It's another one to distribute. And
they're not the same strategy.
They're not the same, and just not enough attention is paid to the distribution phase. You reached your $1 million or $2 million or 500,000, whatever your number was. Congratulations. Good luck to you. That's not good.
Or you've reached a number. What is that number going to be able to provide for you? I have a meeting with somebody later today, and based on what they told me they need to spend, the question you've heard me say before is, why are you working? You want
they enjoy it.
$75,000, $80,000 a year.
Yeah.
And that's only a 2% distribution.
Yeah.
I mean, you're working, which is fine. You want to keep working. You're working because you enjoy it, you want to, and all that. You're not doing it for the money. You are financially independent now.
Yeah.
So
their fear, that fear should be gone. The fear of...
But they were worried they didn't have enough money to retire. They thought they had to have more.
Well, and okay, that's fine. That's fine. But again, that's sort of the emotional aspect of it.
Very much.
We talked buckets. Don't forget, I should mention this again. Boy, this is going on gangbusters. This retirement, this buckets guide, this guide that you can download from luciacap.com. I was just checking. This is one of the most popular things we put up there, along with the Social Security guide, and we have an estate planning guide.
Yes.
How about that? So
they all go together.
Right. So go to the search bar at luciacap.com. This is in the upper right. You can type in bucket strategy, and you'll see the result that'll give you the download, the PDF, free download for your bucket strategy guide. Tell you everything you need to know about buckets, even stuff you didn't think you needed to know. It's all in there. Also, estate planning. You can type in estate planning, and then that estate planning guide will show up. Different ways to access these things. I would suggest you do that.
But they're all important. Social Security is one of the foundational issues of your retirement plan. You need to get the choices of when to take it, whether you take yours, spousal, all these things. That's important. Getting your bucket strategy correct to support your retirement income years is important. And coordinating your estate plan with what you're doing in other account titling, beneficiary assignments, and things that is very important, so that things become easier for your loved ones when you're not here to help them.
Yeah, and presumably that's why you've been saving for yourself and maybe some heirs too. Go to luciacap.com, luciacap.com. You can get in touch with Professor Plum or any of the Lucia Capital Group advisors. How can they help you? I mean, just think about it. They're one of the first things they're going to ask you when you're sitting down and meet with them is, how can we help you the most, right?
Now, for people that are in retirement that maybe they have a bucket strategy, one of the things they may want to consider is actively involving some of their kids or whoever they want. Start teaching them about buckets. Yeah. Start teaching them about why you are doing.
Why you're doing what you're doing.
Because at some point you may not be able to do what you're doing, not from a financial standpoint, but from a physical, mental standpoint. And you want it to continue on. So bring your kids, but it also will help your kids get involved in their own strategy planning and help them build their net worth, help them create so that maybe you don't have to worry about, I've got to make sure that I leave my kids a bunch of money because they're never going to have any. Get your kids involved. Get your beneficiaries involved.
It'd be helpful for them to understand how to make their money last, too.
Or on the other side, realize that you ain't leaving them a ton and they're on their own.
That could very well be, too.
Spending it all.
Give them a call, 800-644-1150. That's right. Involve your kids or your heirs or whoever they happen to be. 800-644-1150. The podcast, Managing Your Financial Future. You can find us, of course, on Apple Podcasts. You can go to Spotify, subscribe to these podcasts, download them every single week, and never, ever miss an episode. This has been we're only, 7 or 8 episodes into this season. This has been fantastic. I mean, from an informational standpoint, I'm the guy hosting this thing, and I'm, it sounds like I'm just...
I think 173 of this season is very I've done pretty good.
We got to do something for our 200th episode. You know, that's only
we gotta
like
get to it first.
That's only like 6 months away,
Yeah.
right? Oh. We do appreciate. I appreciate you being here. I know you got to meet with some folks, and
Yes.
you know, as you always do. I grab you whenever you have a moment. So you know,
I got to stop walking through the lobby.
is there no you know, as we approach the, you know, we're in spring, as we get into the summer months, is there no slowdown at all, or is
There will be for me. I will be in the office for multiple times.
Okay, all right. Well, we're going to have to get ahead of the.
I may
ahead
take a
of the
whole
game.
month out of the office.
Wow, look at you.
Still be accessible for client reviews and discussing
Just
things
not
over the
physically
phone.
there.
I just won't be physically in the office. I won't be in the podcast studio, this luscious, luxury, appointed office that we have.
It is kind of nice, I will say that. All right, enough of that. Thank you, Professor Plum.
You're welcome.
As always, I appreciate that. For Professor Rick Plum, I'm your podcast host, Johnny Dean. This has been Managing Your Financial Future. We got another great one next week. Tune in next week and find out. Until then, thanks so much for listening. Talk to you next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstance. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. S&P 500 Index is an unmanaged index that includes a representative sample of large cap U.S. companies and leading industries. An investment may not be made directly in an index. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.